Hey guys, what's up? How's it going? Robin here. Welcome back for another video on the channel. In today's video, I'm going to be sharing with you guys two undervalued high yield Canadian dividend stocks worth buying going into October 2020. So the market over the past few days has been pretty crazy, and in today's video, I'm going to focus mostly on Canadian REITs, and I'm going to share with you guys two REIT stocks that are worth buying right now. And as you guys probably know, REITs have been absolutely killing it over the past month or so. In fact, as you guys can see here, my REIT portfolio is up 21% in the past month here in Wealthsimple Trade. That's a gain of $859 over the past month with some of these Canadian REITs, and some REITs that just have huge returns right now. So I think it's appropriate to talk about Canadian REITs in today's video. And of course, guys, like usual, if you guys are enjoying the video, please be sure to give it a big thumbs up, and remember to subscribe to the channel if you guys want more Canadian-based investing content. Alright guys, so the first undervalued Canadian-based REIT that I think is worth investing into right now is none other than H&R REIT. So for starters, H&R REIT is a pretty decently sized REIT. They currently have a market cap of $4.1 billion here. So as you guys can see, they're a pretty decently sized Canadian REIT. H&R REIT's portfolio mostly consists of office, retail, residential, and industrial properties within Canada, as well as some properties in the US. And this is a nice, good set of diversification. And it's nice to see this diversification given the circumstances that we had this year. And as you guys can see on the website, they have 40% office properties, 28% retail, 9% industrial, and 23% residential. The current dividend yield of H&R REIT at the time of doing this video is currently sitting at about 4.7%, and this isn't super high, but it's pretty decent for a REIT, and we'll talk a little bit more about the dividend yield a little bit later on in this video. But at the end of the day, I think this is pretty decent, all things considered. So H&R REIT's FFO payout ratio is currently sitting at around 50%. It says 40% here, but things have changed a little bit, so it's around that 40 to 50% ratio, which is pretty low. So AFFO payout ratio is basically the same payout ratio that we'd consider when it comes to dividend stocks, but in this case, this is what we pay attention to when it comes to REITs. So a payout ratio of 41 to 50% is pretty decent, all things considered, for H&R REIT, and basically tells us that this REIT has lots of increases to come in the future. This is also one of the most conservative payout ratios when it comes to all Canadian REITs. Now, I honestly believe that this is good news at the end of the day, because this allows us to get some distribution growth going into the future. So if you buy the stock right now, you can kind of lock it in and guarantee to get some increases further down the line over the next couple years. H&R REIT was hit pretty hard by the pandemic, like most Canadian REITs, but as you guys can see over the past couple months, past 6 months, but more specifically the past couple months, H&R REIT has had a nice slow recovery, and it's still growing quite nicely. And when it comes to looking at undervalued stocks, especially in the way the market is right now, I think one of the most important things to look at is what the price of the current stock is trading at versus what it was trading at pre-pandemic. So if you look at the pre-pandemic levels here on Wealthsimple Trade, we can see that H&R REIT is still down negative 32% from before the pandemic happened. So at the end of the day, even though we've seen crazy good growth right now from this REIT, I still think there's tons of room for improvement. So imagine getting like that 32% growth going towards the end of this year and maybe over next year. I think that's absolutely crazy growth potential, plus the combination of locking in that nice distribution yield that is most likely to grow in the future. I think this is the best way to look at undervalued Canadian stocks right now. Now, before we end this video, one important thing we really need to talk about is the fact that H&R REIT cut a big chunk of their dividend earlier this year. Now, H&R REIT cut its dividend by 50% in May earlier this year. This generally isn't a good thing, and it's actually a pretty big red flag when companies cut their dividends. But with everything going on with the pandemic and the fact that the whole economy shut down and we're dealing with REITs, I don't think this is as big of a deal as it might be in, like, let's just say if we were going through a regular year and a company just cut its dividend. And just like most other Canadian REITs, quarter 3 has been pretty solid as well. As you guys can see here, quarter 1 was pretty bad for H&R REIT as well as quarter 2, but quarter 3 had a pretty big bounce back, in fact even earning more than in the previous year. So this is a good sign, and this shows us that things are recovering and that H&R REIT stock will most likely recover a lot of those losses going in the future. And the other thing to mention is that collections in the third quarter has also improved to 95%, and mall rent collections have improved to 83%. So, you know, they're getting that rent control back, and this is basically what's making their earnings go up so much. And the nice thing about REITs is that by law, they are required to pay out 90% of their net income as distribution to shareholders. So as H&R REIT's income will grow and get back to where it was before, they're going to naturally increase that dividend. So if you buy the shares right now, we can lock in the current yield and also guarantee that in the future, that's most likely going to grow quite exponentially. So when it comes to buying this REIT right now, I think the combination of huge stock appreciation as well as some nice dividend increases going in the future is really presenting us with a once in a lifetime opportunity for this REIT. H&R REIT is currently trading for $14.60 on the TSX and trades under the ticker HR.UN, and it has a current dividend yield of 4.73% at the time of recording this video. To give you guys a quick little glance at my portfolio to show you guys how H&R REIT has performed for me, I have 48 shares of H&R REIT that I've kind of mostly been buying since March earlier this year. A total value of $700, and my all-time performance with this REIT is up 48%. That is almost 50% returns with H&R REIT since investing earlier this year. And it currently holds about 14% of my portfolio, and that's a total gain of $227. So absolutely crazy growth with tons of potential to grow even further over the next couple years. Now, the second undervalued Canadian stock that we're going to be talking about today is a stock that I have talked about quite a bit over the past couple days, but I think it's worth mentioning once again because this particular stock I think is one of the most undervalued stocks to buy right now, and that is, as you guys probably have already guessed, RioCan. So if you're like me in the past and you ever wanted to become a landlord without dealing with all the stress that comes with it, then investing into a nice solid Canadian REIT like RioCan, you might want to check it out. So for starters, RioCan is Canada's second largest REIT, and most of its properties are located in the GTA, but real estate just continues to defy all odds and just keeps on increasing at a rapid prices. And once again, just like other Canadian REITs earlier this year, RioCan got hit devastatingly hard towards the end of March in 2020, but as you guys can see, it's had a slow but bumpy recovery, and over the past little while it's also had tremendous gains coming over the past month or so, but still just like H&R REIT still has lots of room to go. If we bring up some stats to Wealth Silver Trade, we can see over the past 3 months RioCan is up 15.71%, and in the past month it is up 22.62%, which once again is absolutely crazy recovery. But once again, just like H&R REIT, if you look over the year-to-date earnings, we can see that RioCan still has tremendous amounts of recovery to happen, still down negative 33%. So once again, I think this is a huge sign that really, Canada's second largest REIT is tremendously undervalued if it's trading negative 33% from last year. So I think this is a perfect time to buy RioCan and lock in their nice juicy dividend yield that is actually almost double the price of H&R REIT's dividend yield. And speaking of dividend yield, RioCan's dividend yield is currently sitting at 8%, which is absolutely tremendous. Now, this dividend yield might decrease going into the future. Nobody really knows, but once again, I think it's worth buying because of the fact that even if it does get decreased, it will still be pretty decent. And the fact that the current value of the stock is so low, I think the gains will just outweigh whatever happens if that ever does end up happening. And just like pretty much all the other companies I talked about in these videos, Q3 has been pretty solid for RioCan, and if Q4, it looks like it's going to be the same way. So we should see tons of recovery going over towards the end of this year and probably leading into the next year of 2021. And of course, guys, just to give you guys a little perspective of how RioCan has performed for me, inside my REIT portfolio with Wealth Silver Trade, I have 48 shares of RioCan, total value of $866. I've been buying RioCan once again since around March time this year. Actually, even bought it some in January and February this year, but our all-time performance is up 17.67%. Absolutely crazy gains once again, and still tons of room to go in the future. That's a total gain of $130, and the average price I paid is $15.34, and it represents about 17% of my portfolio, but I also have it in various ETFs as well. Now, speaking of ETFs, I gave you guys 2 undervalued individual REIT stocks that you can check out, but I'm also a big fan of ETFs, and if you guys have been watching my channel, you know that I base all my portfolios, the base of my portfolios on ETFs, and I'm going to take a peek at an ETF that I hold called the VRE. Now, VRE is Vanguard Canadian Real Estate Fund, and as you guys can see here, this ETF holds a lot of great companies with a lot of diversification in Canada, and if you guys want to add a little bit more stability to your portfolio, you can buy this ETF because you'll get RioCan, which is one of the REITs we talked about, which is a 9% value inside this ETF. So every time you buy one share, you'll get 9%, or basically 9 to 10% of RioCan, and you'll also get about 6% of H&R REIT, as well as these other holdings inside the ETF. So definitely check that out if you guys like the ETF option of buying Canadian REITs. And just like the individual companies I talked about, VRE, although the growth potential in the future isn't as much, you guys can see that it's still trading down negative 15% 15% year over year. So I think it's still worth adding to your portfolio. And VRE has had tremendous growth over the past 5 to 10 years. So it's done really, really well, and it's been pretty consistent. I currently own 44 shares of VRE, which is the bulk of my REIT-based portfolio, total value of $130,349, and I'm currently up 13%, which is pretty solid for an ETF all time. And it's got a nice monthly dividend yield, and it's currently about 26% of my portfolio. And one other important thing I want to talk about in this video before we end it up really quickly here is that when it comes to REITs, if you guys can and you guys have contribution room, definitely stick them inside your TFSA. I didn't stick my REITs inside my TFSA because I didn't know what I wanted to put in my tax-free savings account, because I currently have the bulk of my TFSA invested with Wealthsimple Invest. So basically I have about $50,000 or so inside Wealthsimple Invest inside a TFSA, as you guys can see here. So I wasn't sure what to put my REITs in when I first started investing into them, but honestly guys, at the end of the day, I wish I would have just threw them in a TFSA so I could have gotten some gains. So I'm currently in the process of I emailed Wealthsimple support. I'm trying to get them to transfer my personal account into my TFSA to lock in these earnings and these distribution yields and the growth in the future, and it can hopefully be tax-free. So if you guys have any contribution room for TFSA, I think sticking these two REITs would be a perfect move and give you really good gains going into the future. Alright guys, so that's it for this video. Hope you guys enjoyed it. Please let me know, like usual, what you guys think in the comment section. And if you guys enjoyed this video, be sure to give it a big thumbs up and subscribe to the channel if you guys want more Canadian-based investing content. I'm going to link to a previous video I did before. That's the top 3 undervalued Canadian stocks to buy. Check that video out. I'll put an end screen. You guys can click on that video if you guys want to see more stock picks going towards the end of the year. So let me know what you guys think in the comment section. Thanks for watching, everybody, and I'll see you guys later.